Right, now let's look at section 1 of your paper. So where you get 10 MCQs. Sometimes students think, okay, this is very easy, but don't take it for granted, because if you do not get the correct answer straight away, you lose 2 marks. So unlike the section 2 and section 3, there's some possibility that you can score some marks, but here all or nothing. Either you get 2 marks or else 0. So you have to be spot on, you have to be precise when answering these questions. Okay, so let's look at the first one. Which of the following is a qualification required of a liquidator under the Companies Act number 7 of 2007 Act? For you to become a liquidator, what qualifications that you need to have? Let's look at the first one. Should be a person between the ages of 16 to 55 years. Should be a creditor of the company at the point of starting the winding up proceedings. Or should be a person who is an undischarged bankrupt. Should be a person who has not been disqualified by courts to function as a director under the Act. Okay, so pause the video and you decide the answer. I mean, don't listen to my, don't pause the video, decide what the answer should be, and then after that you should listen to my explanation. So let's see what the answer should be in this situation. What is the answer here? Now for this you have to look at the relevant provision applicable to a liquidator. So there you have to look at section 383 of the Companies Act. Section 383 of the Companies Act, that specifies the qualification that a liquidator should have. Accordingly, you will see that person should be, should be a person between ages of 16 to 55 years. No, there's nothing such. Should be a creditor of the company at the point of starting. Now, if you're not sure about the answer, one approach that you can take is, you can exclude the odd answers. I mean, there are answers which are sometimes, I would say, stupid answers. I mean, it doesn't make any sense at all. So there are answers, when you use your common sense, you realize this cannot be the answer. You know, there cannot be an age limit for directors. Yes, there's an age limit, but saying 55 years after that you can't become. Now, you know, most of the chartered accountants function as liquidators. In court, we have seen most of the time when a liquidator is appointed, those are chartered accountants. So if a chartered accountant cannot act as a liquidator after 55 years, what happens? It's not practical, isn't it? So should be a creditor of the company at the point of starting the winding up. Now in that case, that means only, what if the company doesn't have a creditor? If it is a liability free company, then you can't appoint a liquidator. So that doesn't make sense actually. So it cannot be a qualification. Then should be a person who is an undischarged bankrupt. Undischarged bankrupt. Who is a bankrupt? A bankrupt is a person who had been considered by court as a person who cannot settle his liabilities. A bankrupt is a person who does not have enough assets to settle his or her liabilities. If you are a bankrupt person, remember, now it's like this, you can get a court order stating that I am a bankrupt. Now think of the situation like Sakviti Ranasinghe. He went bankrupt, therefore he was sent to prison. But the thing is, he did not have to settle the liabilities because he was a bankrupt person. If you are a bankrupt person, obviously you can't settle the liabilities, then you have to go to court and get a declaration of bankruptcy. The court says this person is a bankrupt. That means he doesn't have to settle the liabilities. Then you might be thinking, wow, it's good, you take loans and then you say, here I am a bankrupt person, therefore I can't pay you. And you go take a court order saying I am a bankrupt. Yes, you can do that, but at the same time, remember, you lose a lot of rights as an individual. If you are a bankrupt person, remember, you can't enter into contracts. A bankrupt person can't enter into any contract. That person cannot function as a liquidator. That person cannot function as a director of the company. Lot of restrictions are there. And at some point, if let's say you want to become a director of a company, or you want to be a liquidator of a company, or you want to start new employment, then you get salaries, you get money. You can't do that while remain as a bankrupt person. Then you have to again go to court and get a order to discharge you from bankrupt. You have to get an order to discharge. Until such time you are discharged as a bankrupt, that means you have to release, you should be released as a bankrupt. The court has to make a declaration and say, so you were a bankrupt, now you go back to court and say, here, now I am okay, please remove the bankrupt declaration. But the moment you do that, whatever the liabilities that you couldn't settle, now you have to settle it. But what I wanted to explain here, while you remain as an undischarged bankrupt, you can't be a liquidator. You can't be a liquidator. Here, if you are a discharge from bankruptcy, then you can be a liquidator, but you can't pick C because it says you should be a person who is an undischarged. That means you remain as a bankrupt. While you remain as a bankrupt, you can't be a liquidator. So the answer is you should be a person who has not been disqualified by courts to function as director under the Act. So if you have not been disqualified by courts to function as a director, then you have the right to be a liquidator as well. So the answer is D. So here the answer is D. Then the next one. The following statements were made in relation to mismanagement under the Companies Act. Now, when it comes to mismanagement, you know oppression and mismanagement. You have to look at section 224, 225, 226. So those are the provisions pertaining to mismanagement. So let's see. The following statements were made in relation to mismanagement under the Companies Act. The term mismanagement is defined in the Act. Then what you should do? Go to section 224 and see whether they have defined the term mismanagement. Then an act of the management which results in a prejudice being caused to the interest of the company falls within the scope of mismanagement. Any shareholder, as long as he holds at least 1% ordinary share in the company, can file an action in court for mismanagement. Mismanagement includes both actions as well as inactions. That means doing something to harm the company, and inaction means you allow someone to harm the company. Inaction means you do nothing to protect the company. Inaction of the management of the company whereby a prejudice is caused to the interest of the company. Which of the above statements is or are correct? Now for this, let me straight away refer to the relevant section from the Companies Act. Shall we go through the relevant section? Then it would be easier for us to understand. So you have the Companies Act at the exam. Refer to the section and then you will be able to figure out the answer. So oppression is about section 224. Then let's see mismanagement. So they were referring to mainly mismanagement here. Any shareholder company having complained that the affairs of the company are being conducted in a manner prejudicial to the interest of the company. Prejudicial to the interest of the company. Then that a material change not being a change brought about by or in the interest of any creditors including debenture. So anyway, they explain the requirements, I mean the ingredients of mismanagement. Then what does it say? Where an application made under the provision of subsection 1 if the court is of the opinion that the affairs of the company have been conducted as referred to in subsection 1. So, here it explains in detail what basically mismanagement is, where by an alteration in boards of directors of his agents or secretary or in the constitution or control of the firm or body corporate acting as its agents, and by reason of such change is likely that the affairs of the company may be conducted in a manner prejudicial to the interest of the company. So, then they go on and explain what mismanagement is. So, you need to go through it beforehand. I am just trying to show you the parts relevant to get the answer. So, then you have to look at all these sections actually, 224, 25 and then 26. Look at 26. Who can bring an application under 224 and 25? An application under section 224 or section 225 may only be made by a shareholder or shareholders who at any time during the 6 months prior to making of the application constituted not less than 5% of the total number of shareholders. So, that means for you to bring an action under oppression or mismanagement, you have to be a shareholder who has at least 5% of the shareholding of the company, 5% of the shareholding of the company. So, now let us look at the section. Now let us look at the question again and we will get the answer. Okay. Now, the term mismanagement is defined in the Act. It explains the ingredients, but they don't specifically define what mismanagement is. Right? Now, if you want to, I can tell you, you should refer to pages 125 and 126 of the study text to understand this mismanagement part. Then it will be easier. The relevant sections are 224 to 226. They don't actually define what mismanagement is. They just explain the ingredients, that's all. An act of the management which results in prejudice being caused to the interest of the company. I believe when you saw this part when I was going through the section, falls within the scope of mismanagement. This is correct. Any shareholder as long as he hold at least one ordinary share. No, that is not correct. You have to have at least 5% of the shareholding of the company. Then fourth one, so first one is out, third one is out. Then mismanagement includes both actions as well as inactions. That is correct actually. Even though you do something positive to harm the company or you allow someone to do something harmful to the company without making any attempt to protect the company, both fall within the definition of, fall within the concept of mismanagement. Accordingly, Roman 2 and Roman 4 are correct. So, the answer should be C. Then let us look at the next one also. According to the Foreign Exchange Act number 12 of 2017, I told you about this. A person resident outside Sri Lanka is permitted to invest up to 40% of the stated capital of the company. I told you there is a gazette notification issued to this effect. I think you should refer to page number 184 and 185 of the textbook. So, that explain, I told you about this during my other explanations, that you must be familiar with this situation. At least you will be given a question as MCQs. As a foreigner, if you want to invest in a company as a shareholder, there are prohibited areas, there are restricted areas, there are certain areas where you need permission. Now, here there are certain industries where you are it's not prohibited. It's not prohibited. You are permitted to invest, but only up to 40% of the stated capital of the company. Only up to 40%, not beyond that. As long as that company is engaged in certain specified businesses. Which of the following is one such permitted business? So you should know the answer at once, because here you have to be spot on. It is education. It is education. So in that case, so basically you can invest up to 40% of the stated capital of the company. So the answer should be B. So the answer is B here, education. If you look at the other areas now under the Foreign Exchange Act, there are two lists basically given: prohibited areas and areas where you are permitted to invest up to a particular percentage, like 40% here. Now if you take pawnbroking, then coastal fishing, air transportation are basically restricted or prohibited areas where foreigners are not supposed to invest. Now here it's air transportation. Now domestic air transportation is permitted, but air transportation in general is a prohibited area for foreigners. So basically education is an area where the foreigners are permitted to invest up to 40%. Okay. Then we look at the next question. The following statements were made in relation to the grounds on which a company may be wound up voluntarily under the Companies Act number 7 of 2007. Now in this instance, you must be familiar with voluntary winding up of a company. For that, you have to look at section 270 of the Companies Act, and study text, there is a separate chapter allocated for winding up of the company. So you can look at page numbers 108 to 110 of the textbook to get a better understanding, and accordingly you have to see which of the above statements are correct. Which of the above statements are correct. So let's read them and see. When the company has resolved through a special resolution to be wound up voluntarily. When the company resolves by an ordinary resolution with special notice that due its liabilities it cannot continue its business and therefore it's advisable to wind up. When the duration fixed for the company's existence expires and the company passes an ordinary resolution to wind up voluntarily. When the number of shareholders in the company has reduced to 2. So obviously out of all these only 2 can be correct. So what you should do is look at section 270 of the Companies Act and decide what are the statements which are correct. So if you quickly look at section 270 here, a company may be wound up by the court. So it's by the court here voluntarily. So you can see this is the table of contents. So at the exam also, for you to easily find out the relevant section, you go to the content page, and from there you can figure out where the relevant sections are. Now that is what I am going to do here. To locate the exact section, look at the content. Then it's easy. So But to do this, you should know, you have to go through these sections again and again, especially the content page also, to find out how they have, like, divided the sections of the Companies Act into parts, chapters, and then each chapter is divided into parts. So you must be familiar with that for you to identify it very quickly at the exam. So here you can see voluntary winding up is actually addressed here, starting from section 270. Winding up procedure basically starts there. Now then it goes on up to, so many provisions are included in the Companies Act with regard to winding up. So if you look at circumstances in which the company may be wound up voluntarily. So to be precise, look at section 319 of the Companies Act. Yeah. A company may be wound up voluntarily when the period, if any, fixed for the duration of the company by the articles. This answer was there. When you look at it again, you will be able to see this part was there. That means if you have started the company for a particular objective, or if you have started the company for a fixed period, if you have achieved the objective, or if you have completed the period that you have started the company. Let's assume you have started the company for 5 years. Now 5 years time period has come to an end. In that situation, you can wind up the company voluntarily. For that, you don't have to pass a special resolution. Here it doesn't say you need a special resolution. So that means you can pass an ordinary resolution. Other than that, in other circumstances, you need to pass a special resolution to wind up the company voluntarily. So look at the answer. So here, when the company has resolved through a special resolution to be wound up voluntarily, that is correct. If you have passed a special resolution to wind up the company voluntarily, then it is possible. So the first one is correct. Then the next one, resolved by an ordinary resolution with special notice. No, you can't wind up a company voluntarily by passing an ordinary resolution by giving special notice. In the Companies Act, we can actually see two situations where you can where you have to pass an ordinary resolution with special notice. Ordinary resolution with special notice. One, if you are going to remove an auditor or a director of a company, normally you can pass an ordinary resolution, but you have to give special notice. Not when you are going to wind up a company voluntarily. So second one is wrong. Then Roman 4, there was no such thing where we read the section. There was no such requirement stating that if the number of shareholders of the company has reduced to 2, then you can wind up the company voluntarily. What about the single shareholder companies then? No. So 2 and 4 are out. Let's look at Roman 3. It was there. When the duration fixed for company's existence expires, if you have started the company for a fixed time period, if the time period has come to an end, let's say 5 years, then you don't have to pass a special resolution. By merely passing an ordinary resolution, you can wind up the company. Otherwise, you have to normally pass a special resolution. But if you have started the company for a particular period, if that time period has come to an end, then without passing a special resolution, by passing an ordinary resolution, you can wind up the company. So Roman 1 and Roman 3 are correct. So the correct answer should be B then. Correct answer should be B. Then again you can see a question from the Foreign Exchange Act number 12 of 2017. Right? So it says, it allows a person resident in Sri Lanka to channel funds for eligible overseas investments through outward investment account. A person resident in Sri Lanka. So there are two situations. A foreigner invests in Sri Lanka. Then they have to open up a inward investment account. So investments coming in, inward investment. Now if you are a Sri Lankan, a resident in Sri Lanka, you want to go and invest outside the country. Then you have to channel your investment through an outward investment account. But in doing that, you cannot, if a Sri Lankan wants to go and invest outside the country, that has to be channeled through an outward investment account. But in doing that, you can go and invest in any investment opportunity that you have. It's not possible. Which of the following is one such eligible investment? So here, obviously it's not in the Companies Act, so you have to memorize it, or else what you can do is, in the Companies Act, pick a particular, empty area, and you can write down from the Foreign Exchange Act number 12 of 2017, what are the eligible investments. So when you go through it, you will see to acquire and hold shares of a company. Very easy actually. As a Sri Lankan, like other foreigners invest in our Colombo Stock Exchange, we also can go and invest in other stock exchange. If you want, you can go and invest in New York Stock Exchange. If those people permit you, you can do it. From Sri Lanka, there is no restriction. So actually, here the answer is A. Others are actually not eligible investments. So refer to pages 187 and 188 of the textbook. So then you can get a better understanding. Here the answer is A. So to acquire and hold shares of a company incorporated. But let's read the others also. To acquire and hold sovereign bonds issued by the Sri Lankan government. These sovereign bonds are issued to foreigners. Sovereign bonds are issued to foreigners by the Sri Lankan government. Here, this is a situation, a Sri Lankan is going to invest outside the country through an outward investment account. For an individual professional to set up and maintain an overseas office in a foreign country, no, these are restricted areas. For an individual to set up and maintain marketing office, so these are restricted areas actually. So here the easiest answer, as an individual, allows a person resident in Sri Lanka to channel funds. So there are restricted areas for individuals, companies, likewise it's given. So here any person can go and invest in shares of company incorporated outside Sri Lanka. Right, so that is possible, it's an eligible investment, so the answer is A. Then look at 1.6. Given below are some duties of directors. So this is a question that they have asked from duties of directors. Which of the above are duties of directors? Before reading this, look at the requirement. Then read whatever you have been given. It can save it will save a lot of time. Which of the above are duties of directors as stated in the Companies Act number 7 of 2007? Okay. Now, if you look at the duties of directors, it's very clear. Under the previous Companies Act, there were no statutory duties mentioned in the Companies Act. For the first time, duties of directors were codified into 2007 Companies Act. So if you look at sections 187, 88, 89, you will be able to see these duties of directors. So now if you look at the Companies Act, you can clearly identify there is a part allocated for duties of directors. So then go through that part and decide whether those are duties identified by the Companies Act number 7 of 2007. Okay, so let's see. A director has a duty to act in good faith in the interests of the company. Now, I don't have time to explain each and every duty, but in this situation, I must tell you, yes, a director has a duty to act in good faith in the interest of the company. Then, a director of a company shall not agree to the company contravening any provision of the Act. Obviously, every director has the obligation to act within the Companies Act. That is also a duty. Then a director must exercise a degree of skill and care that is reasonably expected of a person of his knowledge and experience. Yes, that is also a duty. A director has a duty to act in the best interest of the shareholder who nominated him or to her to the post of director. Obviously, when you read it, you should be able to understand this cannot be an answer. This cannot be a duty. Now, when I am appointed as a director, I owe my duty to all the shareholders in general. It's like this. When a president is appointed to a country, when a prime minister is appointed to a country, he will be elected by certain group of people. Now, the current president, we say commonly, everybody says, he is appointed by 69 million people of this country. But once he is appointed, he should work for the benefit of all the people in the country, not only for the people who voted for him, but even he is the president of every person in this country, every citizen of this country, voted or not. So, his duty is toward the whole country, not only towards the people who voted in favor of him, who voted for him. So, likewise, when a director is appointed, his duty is towards all the shareholders of the company in general, not only towards the shareholders who voted to appoint him, no, who nominated him or her to the post of director. So, if you look at here, I think if you look at the content page, it is easier to understand. Again, the directors of duties. That's why from this you can figure out lot of things. So, here this part is about auditors. Likewise, you have an area allocated for the directors of the company. Here, directors' duties, 187, 188, 189. What does it say? Duty of directors to act in good faith and interest of the company. Directors to comply with the Act and Companies articles. Directors' standard of care. All three duties, it's mentioned here from Roman 1 to Roman 3. This is not stated as a duty. Obviously, it cannot be a duty. If you use your common sense, you will be able to understand. Therefore, Roman 1, Roman 2, Roman 3, all are duties of directors identified under Companies Act number 7, 187, 88, 89. You will be able to see these duties. Accordingly, the answer is C, Roman 1, Roman 2, Roman 3 only. Then we come to 1.7, the seventh question. Okay. Under the Land Restriction on Alienation Act, there was a question under section 2 also. Does not permit a company incorporated in Sri Lanka to own land in Sri Lanka if, what's the answer? We discussed this actually under section 2. We will be discussing, if you have not looked at section 2 and section 3, then you will not be able to understand this, but we will be discussing this part under section 2. Anyway, a foreigner cannot own properties in Sri Lanka through, a company, I'll put it this way, a company which has a foreign shareholding of 50% or more cannot purchase directly or indirectly, cannot purchase properties in Sri Lanka. So, doesn't permit a company incorporated in Sri Lanka to own land in Sri Lanka if 50% or more of that company's shareholding is held either directly or indirectly by a foreigner or a foreign company. It's not possible. So, the answer in this instance is 50%. It comes from the Land Restriction on Alienation Act. So, if you go to the textbook, page number 189, you will be able to figure out this. Alright, okay. And so the answer is B. Then let's look at 1.8. The Companies Act number 7 of 2007 Act introduced restraining orders as one of the relief available to minority shareholders of the company. Now, under section 2, you will be able to see Foss versus Harbottle rule. So, basically, it upheld the doctrine of majority rule. It upheld the doctrine of majority rule. Okay. Now, according to the majority rule, if the majority shareholders have decided, if you have more than 50% or 75% or more, you can make whatever decision you like, because to pass a resolution in a company, you have to have more than 50%. Then you can pass an ordinary resolution. If you have 75% or more, then you can pass a special resolution. So, if you have only 5% or 10%, basically less than 50%, you cannot influence the company to make certain decisions in the way you want. But if you have the majority in the company, you can make decisions on behalf of the company by passing either an ordinary resolution or special resolution. So, it will be unreasonable for the minority shareholders. So, if there is a situation where a minority shareholder feels that the company or the majority of the shareholders, they are making decisions at the detriment of the minority shareholders, or while creating an unfair prejudice to the minority shareholder, in such situations, under the Companies Act 2007, such minority shareholders can obtain a restraining order to prevent the company by making certain decisions. So, let's look at section 233 of the Companies Act, which explains what a restraining order is. So, you can see section 233. Yeah. The court may, on an application made under this section, make an order restraining a company that, or a director of a company who proposes to engage in a conduct that would contravene the articles of the company or any provision of this act, may from engaging in that conduct. So, a restraining order is basically obtained to prevent someone by doing something. If the other party, let's say the directors of the company, they are going to acquire a property and they have a personal interest in that transaction, and that transaction is extremely harmful to the company. Therefore, maybe one director, majority directors want to go ahead with that transaction because they have a personal interest, or therefore, but there is a director who is against this transaction. So, that director or some shareholder can go to court to obtain a restraining order to prevent the board of directors by acquiring that land. But you must understand, if the board of directors have already acquired the land, then you can't obtain a restraining order, because then it's too late. The transaction has already gone through. Restraining orders can only be obtained to prevent someone by doing something if it has not already occurred. If it is already occurred, then you can't obtain restraining order. That's why it says, proposes to engage in a conduct that would contravene. Proposes. That means it has not happened yet, going to happen. Before it happens, you have to take the restraining order. If it has already happened, then restraining order will not be the proper remedy. So, with that, let's see what the answer should be. Okay. So, here the correct statement in relation to such restraining orders would be, a restraining order may be granted by court to prevent the company or its directors from contravening the articles of association of the company. Now, that goes with section 233. B, since a restraining order is not in the nature of a final order, it doesn't have the effect of a judgment. No, it's not correct. So, what do we have to? The correct statement, yes. So, it's not correct. An application to court for a restraining order against a company can be made only by a shareholder of that particular company. No, we looked at here, not only a shareholder, even a director can make an application to obtain a restraining order. Not only a shareholder. Look at 233 subsection 2. An application may be made by the company or a director or shareholder of the company. So if you know the section, you can read the section and find out the answer for this question. So C is not correct. Generally, restraining orders are issued by court in relation to any completed course of action. I told you specifically, if the course of action is completed, no point of restraining order, taking a restraining order, because it has already occurred. Too late. The purpose of restraining order to stop something, you are trying to stop by something happening. Therefore, D is also inaccurate. So the only answer which is correct here is A. So for 1.8, the answer is A. Then let's look at the next question also. The provisions of the Companies Act number 7 of 2007 Act set out the parameters in relation to derivative actions. So this is also a new area that was introduced under the Companies Act. Under the old Act also the derivative actions were there, but it was not part of the old Companies Act. It was not a statutory remedy, but for the first time they made derivative action a statutory remedy. What is a derivative action? This is more fully explained under section 234 of the Companies Act. So let's look at section 234. A derivative action, as I have explained under section 2, or as I am going to explain under section 2, because by the time you listen to this part, if you have not listened to section 2, then you will be a little confused. But anyway, a derivative action is a situation where a minority shareholder is given the opportunity to take legal action on behalf of the company. Normally, according to separate legal personality principle, if a company is suffering a loss, if someone is causing a loss to the company has to take legal action. The company is the proper claimant, as held in the case of Foss versus Harbottle, the majority rule. If the company is suffering a loss, let the company file an action, because the company can do that. Company is a separate person. Therefore, if the company is suffering a loss, the shareholders cannot take legal action on behalf of the company. Then you are going against separate legal personality principle. Then you are going against the majority rule principle. But there is an exception to those principles, that is derivative action. This is a special situation where a shareholder, especially a minority shareholder, is permitted to take legal action on behalf of the company. So there, the shareholder doesn't bring the action on his behalf. Instead, he is bringing the action on behalf of the company, stating someone is harming or causing damages to the company. If you succeed, then the judgment will be given in favor of the company, not in favor of the shareholder who filed the action, because he just filed the action on behalf of the company. If you succeed, the benefit goes to the company, not to the shareholder. That is the significant nature of a derivative action. So here, section 234 explains what a derivative action is. Here it says, subject to the provision of subsection 3 and 4 of this section, the court may, on the application of a shareholder or a director of a company, grant leave to that shareholder or director to bring proceedings in the name and on behalf of the company or any subsidiary of that company. So that is the main characteristic of a derivative action, but there is a major procedure to follow when you are bringing a derivative action, and something that we don't have time to discuss right now, but it's an important protection available to a minority shareholder of a company. So now let's see whether we can pick the answer based on what we looked at under section 234. So the correct statement in relation to derivative action under the Act would be, it is an action brought by a director on behalf of the shareholder. No, it's not an action you have brought on behalf of a shareholder. It's an action. Look at section 234 again. It's an action that you have brought on behalf of the company or any subsidiary of that company. Who can bring that action? Application, a shareholder of the company or director of the company can bring an action on behalf of the company or subsidiary of the company. So, it's very clear A is not correct. It is an action which ensures that implementation of specific duties owed to the shareholders by the company. Not at all. So, that it cannot be correct. A derivative action can be maintained independent of the court granting leave to proceed with the action. Okay, let's look at D also. That doesn't explain derivative action properly. Because here they want us to find out what a derivative action is. It's clearly explained under 234, and you can see D should be the answer because it goes with section 234. So it is an action brought by a shareholder on behalf of a company to redress a wrong done to the company. If someone has caused damages to the company, wrong done to the company, on behalf of the company, you can bring an action. That is what we call a derivative action. So the answer is D. Okay, let's look at the last MCQ here. The Companies Act number 7 of 2007 provides for the appointment of an external auditor to a company. Provides for the appointment of an external auditor to a company. The correct provision in relationship, now I think even audit and assurance, under audit and assurance you discuss these things because as chartered accountants, obviously you must be familiar with these provisions. Provisions applicable to an auditor. If you are working for an audit firm, definitely you should know the relevant provisions that are applicable to an auditor, audit firm under the Companies Act because they are practically important. One day if you are going to practice as an auditor, then of course these provisions are important, though you are not going to become lawyers at the end of the day. But they are directly relevant to you in your professional career. So the correct provision: to appoint an auditor, a special resolution of the shareholders must be passed. Definitely not. You need to pass only an ordinary resolution. Then when the first auditor of a company is appointed by its directors before its first annual general meeting, such auditor can hold office till the end of the second AGM. Now here the relevant section to for the appointment of an auditor is section 154. So we can look at section 154. That's fine. But I must tell you, the first auditor, now normally an auditor is appointed by the shareholders of the company by passing an ordinary resolution. But the first auditor can be appointed by the board of directors. If the first auditor is appointed by the board of directors of the company, then that auditor can remain in office until the end of the first AGM. At the first AGM, you should allow the shareholders of the company to appoint a new auditor or to reappoint the same auditor. But here they say the first auditor can hold office till the end of the second AGM. No, that's not correct. They can hold office until the end of the first AGM. Therefore, the second one is also not correct. Then, if all partners of a partnership are chartered accountants, then such partnership can be appointed as the auditor of the company. You should know that this statement is correct. If an audit firm, now if you are saying an audit firm, that firm should consist of partners. And for you to conduct an audit, now an auditor can be an individual chartered accountant. Or else an audit can be conducted by an audit firm. If an audit firm to conduct an audit, remember all the partners of the audit firm must be chartered accountants. If all partners of a partnership are chartered accountants, then such partnership can be appointed as the auditor of a company. So for an audit firm, a firm is a partnership. A partnership to become an auditor, all the partners of that partnership must be chartered accountants. Chartered accountants. Because it's a requirement. So that is why if you know I think you guys must be familiar with it if you are working for audit firms like PwC, KPMG, EY. So you can see now there's something called, they are not partners, but they are equivalent to partners. We call them principals. Now why do we call them principal? Sometimes, yeah, tax principal, audit principal. We don't call them audit partner. That is because they are not chartered accountants. If they are not chartered accountants, they cannot be a partner of that audit firm, because if all the partners are chartered accountants only, then they can function as an audit firm. Then only they can function as audit firm. So straight away we have got the answer. So C should be the correct answer. But let's read the last part also. The appointment of the auditor is a power generally vested in the board of directors. Obviously not, except for the first auditor. After that, the auditors must be appointed by the shareholders of the company by passing an ordinary resolution. So the D is also not correct. So the correct answer is C. So with that, we have discussed section 1 and all the 10 MCQs which you get under section 1. So with that, we conclude the discussion of this, we conclude the session that we started to discuss CL4 corporate law paper that was given in July 2021. So I must thank the Chartered Institute for inviting me to do this session and for organizing this webinar, which will be very useful for the students who are going to face their exam in December. So with that, I would like to wind up this discussion while thanking all the people who helped me in doing this session successfully, especially Aruna from the Chartered Institute and Suraj who helped me during the whole 4 hours, I think little more than 4 hours during the whole period, like you know, to make the discussion extremely comfortable. So while thanking everyone who supported me, I would like to conclude my session. Thank you very much and wish you all the very best, and I believe that you will be able to get through all the papers that you are going to sit in your December session. Good luck. Wish you all the very best. Thank you.